Hello. Today I am showing the AM continuation model. I previously showcased the AM reversal model, and this is another model I utilize on a day-to-day basis. This model is the direct opposite of the AM reversal model, and I will go into the requirements concerning how to trade this model. So, as you can see, we have a rough sketch of what the model looks like. You see that price goes to sell side liquidity, fails to reverse, and continues lower, chasing further liquidity. Price is heavily one-sided in these situations, and it is disrespecting opposing PD arrays along the way. This means in this given sketch, bullish fair value gaps, bullish breakers, bullish order blocks, bullish IFVGs are being disrespected. Your job is to find the likely draw on liquidity if price reveals a run on liquidity. Once price fails that reversal, you look for your entry targeting either lower sell side liquidity or higher buy side liquidity if it's a vice versa situation. So the requirements, as stated, before you ever look at price, look at time. This model occurs within 9 to 11 a.m. Eastern Standard Time, which is New York local time. And then and only then do you look at the charts to see if the model is there. Step 1 is a 50-minute breach of liquidity. This means that it goes to the liquidity, like sell side liquidity, and fails to reverse. It will maybe even attempt a slight leg up, but it will fail, be disrespected, and continue lower. Then step 2 is optional, only if it's there. If step 2 is there, if a 15-minute fair value gap is there, in this case, a 15-minute bullish fair value gap. Vice versa, if price was at buy side liquidity, you look for a 15-minute bearish fair value gap. If step 2 is there, you look for that to be disrespected. If it gets disrespected, then you head to the lower time frame for your entry. If there is none, if there is no step 2, then you look for your lower time frame entry. So, to give more detail, I will show you trade examples. This one is including step 2 with the 15-minute fair value gap. As you can see, price goes to sell side liquidity, fails to reverse, and disrespects that 15-minute bullish fair value gap. Upon that disrespect, you look for the lower time frame entry targeting lower sell side liquidity. You can see that there is an obvious lower sell side liquidity. That is the draw that we're targeting. As you can see, once price disrespects that higher time frame fair value gap, it forms a lower time frame entry, being the 1-minute fair value gap. You wait for price to retest it. That's your entry. Stop above the swing high, and you target that draw on liquidity lower. Here, price broke structure. Price disrespected opposing PD arrays, and then formed the entry. As you can see, upon the entry, price went 57 points with little to no drawdown. It was a directional move lower. Price was clearly one-sided. It was disrespecting all PD arrays on all time frames. And so, once price goes to that draw on liquidity, you are out full. Let's look at trade example number 2. This example is without that higher time frame fair value gap, without step 2. So as you can see, price goes to sell side liquidity, fails to form a reversal, and continues lower. You will then look for price to break structure, form a lower time frame PD array to enter upon, and target the next liquidity level, the next likely draw on liquidity. Here you can see price comes to sell side liquidity, fails to reverse, makes a leg lower, and in that leg forms the fair value gap on the 1 minute time frame. You enter only upon the retest of that fair value gap. You put the stop at the swing high, and you target the draw on liquidity, which is lower sell side liquidity. This trade is a 1.6 R to R. I've had better, but when the model shows, and if the risk is reasonable, then size in properly and take the trade, and you do not intervene. You set your levels and you let the trade play out. Follow the requirements of your trade. As you see, price showed no drawdown in that trade. Literally, as soon as it tested that fair value gap, it just dumped to our draw on liquidity for 64 points. Price was clearly one-sided, heading lower, failed to reverse, clearly showed another leg lower, disrespected any opposing PD arrays, and formed an entry. So you take that entry, and in this case, you would get a 64-point move. Now, I advise you all to rewatch this video several times, take notes, study, get a good understanding of this concept, of this model, so you can assimilate it properly. I would backtest it. You should be backtesting it. Don't take my word for it. Backtest it. See for your own eyes this model repeat itself. See for your own eyes all the models I teach you. Get comfortable with it. Once you can locate it in a chart without having to even draw out anything, then you may demo trade. And once you get comfortable with that, then you are ready to trade with live funds. I'm not telling you to go into the markets tomorrow and get right into it. No, the markets are not going anywhere, and you need to take this seriously. You need to get a good understanding and get comfortable with the model before you trade live funds. Now, I'm not saying that this model has a 100% hit rate. It doesn't. You'll take losses. I take losses with these models. But it is highly probable, and it is a profitable strategy. You will profit if you follow this model and don't intervene with it. It will take time. But in November, I'm not speaking for every month. Like I said, this model doesn't have a 100% hit rate. And if anybody tells you their model has a 100% hit rate, run the other way, because they're lying to you. I'm genuinely here for your best interest. And so I will say that in November, this model had a 100% hit rate. That means this model and the AM reversal model in November, I did not lose on a single day. Does that mean that every month is like that? No. I am just saying that in November, I had a 100% hit rate with those two models. Now, most of the time, it won't be like that. Most of the time, it will have over 70% hit rate. So, your job is to locate this in the market, enter when the market tells you to enter, exit when the market tells you to exit, and practice and establish good habits in the process. So, with that being said, I wish you good luck, good trading. If you have any questions, reach out to me. I will answer. I am genuinely here for your best interest. I am here to help you develop. I want to see you guys grow. So if you have any questions, feel free to reach out. I am here for you. And take care.